Now, in this video, we are going to see types of transactions. So let me write the types of transactions. Commercial transactions. Commercial. We can divide them into two. One is cash transaction, another one is credit transaction. So there are two types of commercial transactions. One is cash, another one is credit. So let me start with the credit transaction. Now what do you mean by cash transaction? Cash transaction is a transaction where exchange of goods and services as well as cash will pass on immediately. If you go to the Contract Act, it says executed contract. Here, when I say executed contract, it means both the parties simultaneously perform their whatever their promise. That is where cash transaction is nothing but as far as the contract is concerned or act is concerned, it is executed contract where both the parties fulfill their promise. Credit transaction, here it is nothing but executory contract. Only one party would have done the promise, but the other party yet to perform the promise later. So let me start with the credit transaction. So here, sale of goods or rendering of services to our customers, when it comes into accounting, it is nothing but the past event. Might have occurred yesterday or 2 days earlier. So when it comes to accounting, it is only the past event. So when we consider this for accounting today, this is nothing but the past event, but the realization or receipt of cash will occur only on a future date. It is nothing but here we have done our whatever the promise. So one party has performed, that is nothing but we, the businessman or the trader, whoever it is like, who is accounting the books. Whereas customer part, the another party will perform his promise only on the later date. That means he will make the payment only on the later date. So this is where I said creation of debtor, the customer becomes the debtor. So when you sell goods, what will be the basic understanding? He is the receiver of our goods or maybe receiver of our service. So ultimately we are creating a debtor as well as creation of income. Dual aspect concept. So here we are creating a debtor as well as we are creating an income. Debtor means debit, income means credit. I think you would have understood what will be the meaning of the credit transaction. So in nutshell, when I want to put it in nutshell, sale of goods or rendering of services, we have done our promise, but from customer side it will happen only in the later date. So realization or receipt of cash will occur only in the future date, and ultimately creation of debtor as well as creation of income. That is why I said that the customers who are taking our goods or our services now or have taken our goods or services earlier, but collection of money or receipt of money will happen only on the future date. Who knows that if they fail, automatically it is a loss to us because our goods are given to them but they have not paid for that. Ultimately it becomes a loss. That is why I said that in commercial sense all debtors are bad people. Please understand. That's why I said that debtors are bad. You go back to my first video where I started with who is a debtor and who is a creditor. So debtor is a person who is a bad person. The reason being because of this credit transaction. Because they enjoy the benefits from us now or earlier, but they will give back the reciprocal promise only on a later date, and obviously if they fail to perform their whatever the responsibility or the money payment, automatically they will become bad. The debtors are bad people, and this is nothing but what we in commercialism we call it as debts. Debts, when they turn bad, it becomes bad debts, nothing but our loss. That is why I said that earlier in my first video, debtors are bad people, creditors are good people. So let us take this very clearly. Here, dual aspect concepts also very easily understood. Here you are creating a debtor debit, and on the other side, simultaneously you create an income for that, and that is nothing but the credit. So debit the debtor and credit the income is what this particular transaction mean. So let us start with the credit transaction 2. Here, purchase of goods or receipt of services from the suppliers. So this is the opposite of what we have done earlier. In the earlier thing, what did we have said? That sale of goods and rendering of services. We are giving services to them. But here it is the opposite, other way around. Purchase of goods or receipt of services from the suppliers. So they are the givers here. And for which payment of cash will happen in future. So we take their goods and we take their services, or we have already taken, because I said all accounting transactions are the past events. So we had already purchased goods or we had already received the services from them, but for that we are going to make the payment of cash in the future date. So ultimately it becomes advantageous for us. That is why first credit transaction is very risky. That's why I said that it may turn bad. But here it is our responsibility to make the payment in the future date. So most of us honestly pay it on the whatever the terms and conditions on the date which we have already fixed it. So ultimately payment of cash will happen only in the future, and this is another credit transaction. And here creation of creditor, credit, and creation of expense, which is nothing but debit. We have to go back to the rule, accounting rule, where a creditor is a person who is the giver. So here they are the givers, and on the other side, when we receive something, it may turn into an expense. That is where we say that it can either creation of an expense or an asset. Be careful that. So when you want to find a difference between them, what is an expense and what is an asset? If the consumption happens immediately, it becomes an expense. When the consumption will happen for longer period, more than one accounting period, it turns into an asset. Again, you have to go back to the videos what I had earlier given you, and from there you can understand what is an expense and what is an asset. I have given a definition for that. Please understand. So credit transaction 1, sale of goods or rendering of services, and that is more risk involved, and the reason being the receipt of money will happen only on the later date. At the same time, purchase of goods or receiving of service from the suppliers, and again the onus is on us. We have to make the payment to them, and let us consider honestly that we make the payment at the scheduled date as we have already fixed. So obviously creation of a creditor and creation of an expense or an asset will be the basic accounting treatment as far as credit transaction 2, and risk element is 0, their risk element is 100%. That is why I said that creditors are good people because they are doing everything to us now, but they will be waiting for us to collect the money later. So ultimately, anybody who waits to collect the money later, they are good people only. And anybody who takes our money now, money or money's worth now, and we will be waiting for them to make the payment, they may turn bad also. Ultimately, debtors are bad people and creditors are good people here. Please understand. So we come to the cash transaction now. I had earlier said, as per the contract act, it's an executed contract because both the parties had fulfilled their promise. Look at here. First one, sale of goods or rendering of service against this receipt or realization of cash happen simultaneously. So the risk is zero. Give the money, take the goods. This is where the commercial transaction with respect to cash is nil risk, because you sell the goods and correspondingly you take the money from your customer. So in that case, for all cash transactions, there is no need to know your customer's details at all, unless and until you have a personal contact with the customer. In commercial sense, there is no need to know the details of your customers who take your goods for cash. Similarly, if you buy from your suppliers, the same concept is applied. Again, purchase of goods or receiving of services will result in, I can say, payment of cash simultaneously. Please understand. So as far as 1 is concerned, 2 is concerned, in both the cases, you sell goods, take money, you buy goods, pay money, no risk is involved. So in both the transactions, there is no need for you to know the details of your customer or your supplier. So for cash transaction number 1, we have already seen in the earlier board, sale of goods or rendering of services. For that, creation of income. So you can very much know that it is a credit aspect. At the same time, inflow of cash comes in, debit aspect. So I think you should have understood double entry principle. I had started my first video about the principle of dual aspect concept. I have not deviated from that concept completely. So I have been telling you, please follow the dual aspect concept very clearly. So here, creation of income at the same time, or as well as inflow of cash. Creation of income, which is nothing but credit, and inflow of cash is nothing but, as per the real account concept, cash comes in debit. At the same time, cash transaction number 2, where purchase of goods or receiving the services rendered by others, ultimately here creation of, I say, expense as well as, you can understand, asset also. So what is an asset and what is an expense? Again, you have to go back to my earlier videos and understand the difference between an expense and an asset, please. And then on one side it is a debit, and on the other side outflow of cash, which is nothing but the credit. So now, cash transaction and credit transaction, both of them you understood very clearly. Regarding the examples, we will go to the next videos.